Hey guys, in this video I'll be sharing my 3 favourite dividend paying stocks traded on the ASX, or the Australian Stock Exchange. I'll be basing this off of their payout ratio, their ability to sustainably pay a dividend over the long run through having a solid business, good liquidity, and they should also have managed to increase their dividends over time. This shows that they're becoming more profitable over time and sharing that with shareholders. If you want to see more investing content just like this, if you're already well versed in this area, please feel free to jump straight into the investments using the timestamps below and in the video description. Let's think about a business for a second. Let's say it has a revenue of $1,000 a year, costs of $900, and a profit of $100. The business has 2 options when it comes to the $100 of profit. The first option is to retain the whole or a portion of the $100 and use this to reinvest into the business in a variety of ways. It can acquire a competitor's business, it can reinvest into property, plant, equipment or inventory, or it could also be used for upgrading the premises or paying bonuses to staff. The second option available is to return these funds to the investors, also known as the shareholders or the ones that own the stock, with this distribution being called a dividend. The percentage of the profit that is returned to shareholders each year is called the payout ratio, representing how much of the profits is returned to investors. A second but less common approach is to do a share buyback, which is where the company will use these funds, instead of giving it to the investors, they will instead buy their shares off of the public market. But jumping back into the dividends, when you look at a dividend paying stock, you generally want a high payout ratio as long as the business retains enough cash to keep the wheels turning, so to speak. So a highly profitable business with low capital expenditure tends to be highly prized in the dividend world. A good example of this is the Coca-Cola company. The product, of course, is very profitable. Its revenue grows year after year. It has relatively modest capital expenditure, and it has paid dividends for decades, increasing nearly every single year. This is what I'm looking for on the Australian exchange. The first stock that I like is Nick Scali. Founded in 1962, Nick Scali today is one of Australia's largest importers of quality furniture, like sofas, dining tables, entertainment units, that kind of thing. The Nick Scali group of companies has 2 brands. The first, of course, is their namesake store, which sells at the higher end of the market. In late 2021, they acquired their second brand, Plush Sofas, from the Freedom Furniture Group. This brand tends to sell in the middle or mass market with a more affordable price point. As a group, every year they import a reported 12,000 containers of furniture, making them a big player in this market. Though they have a long history operating in Australia, in 2017 they expanded their footprint into New Zealand and now boast over 100 showrooms between the 2 countries. This includes 5 Nick Scali stores in New Zealand, 66 in Australia, and 36 Plush stores in Australia too. The company has plans to increase their market presence by opening a further 15 Nick Scali stores and over 50 more Plush stores over the coming years. So now let's get into the numbers. Since the pandemic, and including the Plush acquisition in 2021, Nick Scali has nearly doubled their revenue, now standing at over $500 million Australian dollars every single year. Jumping over into their statements, we can see they make a whopping gross margin of over 60%. What this means is that a $5,000 sofa in their showroom only cost them $2,000 when they pay their supplier. With the acquisition of Plush and the falling shipping costs, this increased 2.5% over 2022, which is positive news. Once we subtract out all the other costs of operating, things like wages, rent, taxes, that kind of thing, they still have over $100 million left over each year, or a net profit margin of over 20%, which is very healthy. In addition, if we look over at the cash flow statement, they're handling their cash very well. From their operations alone, this year generated a surplus of $138 million, and with low capex requirements of just 12 million or so, there is a huge surplus to pay a dividend or even stash some funds aside for a rainy day. In 2023, the aggregate funds paid out to shareholders increased 25%, from 48 million to 60. Relative to their net profit of just over $100 million, this represents a payout ratio of 60%, which is consistent with their ratio in 2022, and very healthy. Going back to their cash flow statement, their current cash balance is $50 million healthier in 2023, even with the greater dividend being paid out, giving them a strong foundation to support future dividend payments. Looking at these dividend payments themselves, we can see a steady increase over the past 5 years, even during the COVID-19 pandemic. Looking at the revenue and profit figures above, even though these dipped in 2020, Nick Scali continued to increase their dividend payments to shareholders. Based on current pricing on Sharesies, the current yield is 6.68%. All of this is evidence of a company that puts its shareholders first, and even in a challenging environment, they will continue paying. So to summarize, Nick Scali is a growing business both through organic and inorganic means, with what appears to be a successful acquisition of Plush. They have a high payout ratio of 60%, have consistently increased their dividend over the past 5 years, and have shown signs of being shareholder-led to deliver long-term value. So for these reasons, I'm happy to have Nick Scaley featured in this video as one of the top Australian dividend stocks. Now, moving on to the second one, we have Westpac Bank. There are three main competitors in the space, also listed on the ASX, being the larger CommBank, trailed by the smaller ANZ and National Australia Bank. There are many reasons why I prefer Westpac over the others, which I'll get into shortly. Westpac is, of course, a bank, offering a broad range of services, predominantly in Australia and New Zealand. Something that many of you might not know is that Westpac is actually Australia's oldest company, founded all the way back in 1817. Today, it services over 13 million customers across 4 divisions: consumer, business and wealth, institutional, and New Zealand. In Australia, they capture 21% of the lending market for mortgages and deposits, whereas in New Zealand this is slightly lower, down at 18%. Westpac, in particular, over the other banks, has a strong focus on the environment and sustainability. Every year they produce a comprehensive climate report which outlines everything they're doing internally or financing externally that is good for people and the planet. They also prepare a sustainability pack which discusses how as an institution they are meeting the United Nations sustainability goals. In a world with many companies finding ways to dodge tax, they proudly claim to be Australia's 6th largest taxpayer to the tune of $3.4 billion each and every single year. We must also consider, of course, that they absorb a lot of money out of the economy, as all banks do, which is why they're in this list in the first place. If we dive into the numbers, Westpac has had a 10% uplift in revenue from 2022 to 2023, and owing to some cost cutting, predominantly after the 2021 year, the net profit after taxes has expanded to $7.2 billion. Making it, of course, hugely profitable. There are 2 broad ways that banks can increase their profitability, either by increasing the size of their loan book or increasing their margin on every dollar lent out. By the numbers, Westpac has increased the size of their loan book by 5% over the past year, and if we look over at their net interest margin, this has grown as well. Now if we look over at the dividends, of course during COVID there were a lot of restrictions on paying out a dividend. If we take that out, we can see that dividends have been increasing throughout 2021, 22 and 23, and will soon return back to pre-COVID levels. Over the past year, the total dividends paid per share totaled $1.42, which according to Sharesies represents a yield of 6.23%, the highest among Australia's 4 largest banks. If we consider the net profitability of Westpac is up 26% year over year, a 14% increase in dividends doesn't sound very impressive. This is because Westpac also did a share buyback of $1.5 billion, which also acts as a shareholder distribution, as it means the company's value is divided by a smaller number of shares to arrive at their intrinsic value. As you'll recall, Nick Scaley returns about 60% of its net profit to shareholders each and every single year. Based on a dividend of $1.42 and net earnings per share of $2.05, the payout ratio at Westpac Bank is a higher 69%. They also recognise their sustainable payout should lie between 65 and 75%, offering shareholders some certainty over the future of their dividends. So with a strong payout ratio, a growing loan book and net interest margin, solid market share of about 20% both in Australia and New Zealand, Westpac Bank is a strong dividend stock that you should consider for your portfolio. Now we've come to my third and final dividend stock in this video, Telstra. Telstra, of course, is Australia's largest telecommunications company, which has its roots stretching back as far as 1901. In 1997, the Australian government began to sell Telstra off to private investors, eventually selling the whole thing off in 2011. Today, Telstra has over 1 million shareholders, with their continued success as a business being shared among all of these shareholders, of course. Telstra makes the vast majority of its income from Australian sources, with its foreign business interests growing largely on the back of a large acquisition mid-last year in Digicel. A whopping 85% of its revenue comes from its services divisions, including the profitable mobile segment, as well as fixed offerings such as NBN to both business and consumer customers. Looking at the financials over recent years, Telstra has to be one of the most consistent companies I've seen, with fairly stable revenues, net income, assets, and liabilities. This offers a great platform for a cash cow business such as telecommunications, as it is a rather rigid, asset-heavy industry that not only has sticky demand, but has natural barriers to new entrants. Optus is their largest competitor, which is owned by Singtel, which in turn is owned by the Singapore government through their Temasek investment arm. And if recent news is anything to go by, they're not as reliable as Telstra. What I like about Telstra as a dividend-paying stock is the company's renewed commitment to offer a competitive return to their shareholders. In their capital management framework, they've committed to increasing this over time, in 2023, returning a total of $2 billion to shareholders. According to Sharesies, this represents a dividend yield on current pricing of 4.4%. In the 2023 annual report, the chairman even mentions this payout in his first paragraph. It's important to see this highlighted as it gives us an idea of what management's priority is over the next few years for us as shareholders. The 2023 return to shareholders represents a payout ratio of just over 100%, with a dividend of 17 cents, yet earnings per share of 16.7 cents. This is not sustainable over the long run, as the dividend payment is roughly equal to the company's profitability. But given their commitment to increasing this over time and their billion-dollar cash stockpile, we can assume this will be achievable as the business continues to grow. So we started by looking at Nick Scaley, a leading furniture retailer that continues to grow, and on the back of this, share the proceeds with its shareholders. We then moved on to Westpac Bank, a company aligning itself with the ESG principles many investors are looking for. Along with this, it is hugely profitable and happy to share a majority of this with shareholders each and every single year. And finally, we looked at Telstra, a stalwart of the Australian stock market that has seen extremely stable performance over recent years. It is committed to maximising shareholder returns under their capital management plans. There are many other ASX companies that pay healthy dividends, largely in the mining space. I haven't included those in this video as their performance is tied to commodities that can see wild fluctuations in price. This, of course, is likely to impact dividend payments, where you might have some good years, but you might also have some bad ones. Some dual-listed stocks from New Zealand also pay great dividends on the ASX, including Air New Zealand, KMD Brands, and Fletcher Building. I hope you enjoyed this video. If you did, please make sure to subscribe to my channel down below to see all my future content in the personal finance and investing space. Thanks for watching, and I look forward to catching you on the next one. Cheers.